Hi, my name is Jin Choi and I'm the founder of Money Geek, and welcome to the 12th episode of this short course on investments. And today I want to talk about tax-free savings accounts, also known as TFSAs. Like RRSPs, TFSAs allow you to grow your investments without having to pay taxes on your investment gains. However, TFSAs work very differently from RRSPs when it comes to income tax. As we saw in the last episode, when you contribute into an RRSP, the government treats it as if you didn't earn that income yet. In other words, the government defers your income tax. But when you contribute into a TFSA, from the government's point of view, you did already earn that income. In other words, you don't get to defer your income tax. However, when you take money out from a TFSA, the government doesn't treat that as income either, so they don't tax you. The Canadian government introduced TFSAs in the year 2009, and from the year 2009 until the year 2012, anyone 18 or over could contribute up to $5,000 into a TFSA account. And from 2013 onwards, you could contribute $5,500 into a TFSA account. And if you have unused room, that unused room carried over into the years after, so that if you're 23 or over today, and this is the year 2014 when I made this video, then someone who hasn't contributed yet could contribute up to $31,000 into a TFSA account. Once you contribute money into a TFSA account, you can invest that money into most stocks, bonds, and other financial assets, both Canadian and foreign. So unless you're looking to trade some obscure penny stock that only trades in the US, you can pretty much assume that it's eligible inside your TFSA account. Unfortunately, many banks took advantage of the name tax-free savings accounts, and they gave many people the impression that they can only earn interest inside a tax-free savings account. But this is totally wrong, and this is just one more reason why you might want to move your business from a bank to a discount brokerage. Anyway, once you have your money invested inside your tax-free savings accounts, you can grow your investments without having to pay any form of investment taxes. And that includes taxes on capital gains, taxes on dividends, and interest. The only exception to this rule is foreign dividends. So if you receive dividends from a US stock, then you will get taxed on those dividends. Lastly, when you withdraw money from a tax-free savings account, you don't have to pay any taxes on your withdrawals, and you can also recontribute the amount that you withdrew in a given year back inside a TFSA account, but you will have to wait until the following year to do so. And that's how a TFSA account works. So now, let's walk through the scenario that I introduced in episode 10 and see how much money we end up with if we use a TFSA account. As before, let's say that you earn $60,000 and you earmark $6,000 of those dollars for investment. And at the personal tax rate of 25% today, that means you pay $1,500 to the taxman and you invest the rest. You invest the $4,500 inside a TFSA account. As before, let's say that you're able to double your money in 10 years' time. So you double it to $9,000 inside your tax-free savings account. And let's say that at this point you sell your investments and you withdraw the $9,000, and you can do that tax-free. As we saw in episode 10, paying the full capital gains tax would have left you with $8,235, which means that by using the TFSA account, you were able to save $765. And unlike with an RRSP account, using a tax-free savings account is always more beneficial than using a fully taxable account. However, in certain circumstances, it is more beneficial to use an RRSP rather than a TFSA, especially when you expect your tax rates to go much lower in the future. And that's what I had to say about tax-free savings accounts. So let me briefly summarize what we've learned today. We learned that like RRSPs, TFSAs allow you to grow your investments without having to pay taxes on your investment gains. But unlike an RRSP, contributing into a TFSA doesn't allow you to defer your income taxes. But then again, when you withdraw from a TFSA, you don't have to pay taxes on your withdrawals either. Anyone 18 or over can contribute up to a set amount inside their TFSA each year, and this amount goes up every year for each person. And you can invest in most stocks, bonds, and ETFs, both Canadian and foreign, inside your TFSA. Using a TFSA account will almost always save you money versus using a fully taxable account. But using an RRSP may sometimes be better than using a TFSA, especially when you expect your tax rates to go much lower in the future. So that's what I have for today. In the next episode, we'll talk about Registered Education Savings Plans, also known as RRSPs. So thank you very much for watching, and I hope you have a great day.